This is Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're with two co-authors of the book Marketing Alternative Investments, a comprehensive guide to fundraising and investor relations for private equity and hedge funds. I think this is a very well-timed topic right now because the pressures in the market here in February of 2023 are making lots of things difficult. So our two authors today are Hemali Dassani, who's a fundraiser and consultant to private equity funds. She is a managing director with Caplink Securities, was director of investor relations and chief compliance officer at Agrand Partners, and was a director of investor relations at Castle Harland. She was the president of Harvard Business School Club of Greater New York. She earned her bachelor's at Northwestern University and her MBA at Harvard. Nandu Kuppuswamy, CFA, has been an asset owner and on the asset management side, a rare combination for us here at CFA Society New York. He is the COO and partner at Three Lions Venture Capital and the founder of Ambrosian Sun Advisors. Previously, he has managed investor relations and fundraising for several alternative investments companies. Earlier, he was an asset allocator at Spider Management, which some of you will recognize as the University of Richmond's endowment, and he managed credit risk for one portfolio at Capital One. Nandu is a CFA charter holder. He earned a degree at the India Institute of Technology, Madras, and has an MBA from the Indian Institute of Management, Ahmedabad. He is a member of CFA Society Stamford. Hello to our sister society to the north. So thank you both for being here today on the podcast.
Thank you, Rob.
Thank you.
I'd like to go straight into the weeds because I'm speaking a little bit here for some of the people who are in marketing roles at CFA Society New York. Your book makes a fundamental point that is a good one, I think, is that too many products are sold to clients based on the product's merits, not enough on where they place in the asset allocation of the client or in some directive that the client needs to satisfy. So this is inherently tricky because, of course, there are so many gatekeepers for between the investment manager and the high net worth individual, or the investment manager and the endowment. So how should people out here in CFA land who are thinking about employing some of the things in your book get by that if they don't know who the client is?
Rob, first, thank you for the opportunity, and we really appreciate being here and being able to share our thoughts. To take one step back, I want to say why we think it is important for the message that we are conveying there, and that is, you're not going to be able to sell a product to a client who is sophisticated, understands what they're looking for, and has an objective they are working towards. In that context, trying to force fit a square peg in a round hole will not work. So purely on the merit of efficiency, it doesn't make sense for you to be pursuing something which is not relevant to the client. Now, if you look at a gatekeeper, gatekeepers must reflect the objectives of the client in what they pursue and what they're willing to engage in. And to that degree, they have the same expectation of a marketer or a fund as does the client. So that doesn't change. The one place it does change, though, is that a gatekeeper represents multiple clients. So with one client, you know exactly, you can talk to them and understand what their objectives are, how your product either meets or does not meet their investment objectives, and then decide how to pursue further. Whereas with a gatekeeper, you need to understand what the client base is and then make the decision and the course of action afterwards.
In general, however, when you're creating a thoughtful marketing campaign, I think it's really important to create both a push and a pull strategy, whereby you market to both the gatekeepers and the underlying LPs to create demand around your product.
So yeah, that is exceptionally interesting. I do think, in my experience, it was definitely difficult when talking to gatekeepers who represent groups of people. I'm thinking now of accounting firms, primarily, sometimes law firms. They would be specifically unspecific about those things. So
what in our experience, it has been that most gatekeepers, when you talk to them, especially consultants, fund of funds, anyone who is an advisor to the funds, tend to be much more open to having the conversation because it's their time as well. It's a partnership. if you respect their time and be engaged with them in a manner that is productive to them, they reciprocate in the same manner as well. It's in the best interest. It's a win-win situation by being thoughtful, by being inquisitive and understanding, then go head on into the conversation without actually understanding what you trying to achieve with that conversation.
Right.
And it's important to market to the right gatekeepers.
Mm-hmm.
So some of the larger asset allocators will have multiple gatekeepers involved. Some public pension plans may have upwards of 11 to 12 different consultants and advisors that they use. So in one instance, I was marketing a first-time fund, and lo and behold, most managers were marketing to the larger consultants that were affiliated with that pension plan. I went to a small consultant in Chicago and ultimately got a $25 million commitment for this manager.
Mm-hmm. You know, that kind of talks around one of the other issues that makes it difficult to be thoughtful and poised like that in your approach, is that you have a mandate. You have to get assets.
So I think both Hemali and I would agree that the more thoughtful you are, the easier it gets.
Mm-hmm.
Otherwise, you're constrained by time and resources.
Right.
If you're going after the wrong targets, you're not optimizing either of them.
Right.
So it actually is taking that small step first to understand actually helps you do it better.
It's very difficult to get gatekeepers' attentions from my experience. And in one instance, I was marketing a manager to a bunch of LPs in Singapore. So I reached out to about half a dozen LPs because the partner was going to Asia and wanted to set up a roadshow. Mm-hmm. The very next day, I got a call from Cambridge Associates going out of Singapore, going, "Oh, we'd like to have a conversation with you, Hemali, around your strategy. It's been a few years." And I did a little digging, and the LPs that I had reached out to were actually represented by this consultant.
I see. Yeah. So it is nice. It's that does bring up and also a very important point is you have to be exceptionally flexible, because the person you think you're talking to is not necessarily that one. You know, these are truisms, but I wonder, we've had so many changes wrought by COVID in communication. And this is essentially what we're talking about, is communication. How do the things in your book, or have you all started writing the book during that time when things were in the process of changing? How do you think this has changed? Did it change any of the overall thoughts you had in terms of webcasting or, surviving on text messaging, et cetera, WhatsApp? Did any of that change any of the principles that you created in the book?
I think there have been a lot of changes since COVID. And what I have noticed is that managers are becoming more and more creative when communicating with their LPs. Mm-hmm. So, for example, they may have different webinars that go with, or videos that they've created to go with their quarterly reports that go out to LPs. Mm-hmm. The way that they had conducted AGMs during COVID.
Yep.
One manager actually did group due diligence sessions over Zoom and raised upwards of $5 billion in 3 months.
Really?
Now, that is a 6 standard deviation event.
Yeah.
You can't necessarily implement that if you're, a newer emerging manager. But I have seen a lot of creativity in the marketplace around communications with LPs.
Fundamentally, there are some changes that have come in. First, we started writing the book just before COVID. Mm-hmm. And we went through the phase of seeing some of the changes with COVID and how it was actually coming back to normalcy, quote unquote normalcy there.
Right.
What is definitely different today is that not every LP wants to meet you in person for the first time.
Right.
They want to screen you, they want to have the conversations with you, build the relationship, and then say, yeah, it feels like something it's a very probabilistic investment for me, not something that I'm just exploring to see if it might happen by chance. Mm-hmm. So that amount of certainty is what they're looking for before they engage in an in-person discussion. Still, things are coming back. So for example, if you look at what's happening with the large conferences, since COVID, Obviously, we didn't have any conferences during COVID. But since then, there has been a trend towards some conferences coming in person, but still some staying virtual. An example is New York Commons, NYCRF, actually, their conference was in person this year after 3 years, while TRS still continued to do it virtually.
Right.
So there is still evolving situation. We'll see it over time, but the general attitude is if we can, we will come in person, but we only if there is a need. Otherwise, they're not trying to get it in person. The second part is, despite initial meetings being virtual, there is still a lot of prominence or importance placed towards in-person discussions before people make a commitment. ODD is still in person, obviously has to be in person.
Operational due diligence.
Sorry, my apologies. That has to be in person. And even for building relationships over time, people do engage after you have had a few initial conversations. People want to engage in person after that.
Yeah, I mean, most of these relationships are based on trust.
Yes.
You must establish trust in person. We are all still human beings.
Yeah.
That is what fundamentally hasn't changed.
Yeah.
So the human psychology doesn't change that quickly.
Mm-hmm.
And COVID did put a damper to that, but people are coming back to wanting to meet in person, being somewhere there is that element of, as you said, trust that is built more easily when you're meeting in person than when you're meeting over a Zoom call.
Mm-hmm.
But there is an acceptance of Zoom call for sure, a very large acceptance for Zoom call.
This really helps emerging managers in the beginning phases when they are trying to secure capital. The cost of fundraising is incredibly high for first-time funds. I mean, for any manager, that is. And especially so for first-time funds that may not have capital in the door, and they can have those introductory conversations in a low-risk environment.
Right.
And also the time that you save by travel, that actually, we talked about, I live in Greenwich.
Mm-hmm.
Every conversation I had to have with an investor in New York was always in person. Even though I'm just about an hour away from here, there is still a reluctance of people to meet in person. Nobody's asking me to come here and meet in person until we've built the relationship. So it doesn't matter whether I'm an hour away or half a world away. It actually has made it more efficient. Earlier, it was more difficult for people to come out to New York from, say, India or Asia or anywhere, and then meet with investors. Today, they're able to do it much more easily.
Yeah, I think that, I hope that one of the things that happens, and I definitely experienced this, you would go to a conference and then have 5 meetings in the day after that and take 1 million notes and never read them again. I do not enjoy that. I wonder if you all in the research around the book looked at the structure of firms a little bit. I wonder if there's a gold standard for structure in sales and marketing departments at firms of different size and different subsectors. Have you seen anything like that?
Well, there is no gold standard, but there are so many different flavors of marketing teams. My preference for the larger firms is to have a demarcation between investor relations and fundraising teams. And then some may also have product specialists on their teams that kind of really focus on developing the strategies with the portfolio managers. But there are so many different flavors that you can't say this is the cookie cutter approach to building teams.
Why do you prefer that split between investor relations, product, and salespeople?
Well, I think that it allows marketers to focus on their strengths.
Okay.
Some people are really good fundraisers and are not necessarily as excited about investor relations, and vice versa. Some people love putting together the decks and working with the portfolio manager and addressing the day-to-day questions that LPs may have around their portfolio and getting into the weeds. I mean, other people just love hitting that pavement hard, traveling the world, going to Super Return Berlin and ABCJ in Hong Kong. So I think that having people focus on their strengths and leveraging those strengths can create synergies in your organization. Separately, there are a division of roles and responsibilities that allow individuals to focus on critical tasks. Now, Nandu, you were going to say something?
Yeah, so probably that's exactly where I was heading as well, which is when you're traveling, when you're meeting with investors, there is definitely a lag between when a request comes into you and when you're able to respond to that. When there is a division there, it actually happens seamlessly and much faster. So at the end of the day, IR and marketing are somewhat intertwined, but what the experience to the investor is how quickly you respond to their request, how well you have the interaction with them. If there is a 2-3 day delay, that doesn't speak very well.
Mm-hmm.
If there is the LP doesn't know whether Hemali responded or I responded, the response was from the firm we represent.
Right.
So building that amount of trust with them and continuing to give a higher level of service is very critical. And for large organization, that they can afford to do it. In smaller organizations, it's not practical.
Right.
We have to wear multiple hats at the same time. But if a large organization can afford it, that may be a good approach to take. That's one valuable thing, but there are other disadvantages as well, but there's a great advantage to splitting it up.
Yeah. Isn't one of the advantages to wearing multiple hats isn't one of those that you don't have anybody who gets into the weeds? So, I had this happen. Felt like I was pretty close to a close. The client said they wanted to see the CIO. The CIO brought the CIO in, and he started talking about housing starts. And I was like, we just need signature. So the nice thing about being a person who has some technical knowledge, but also being out with the client is about the pacing better. That's always occurred to me. It's one of the downsides of having specialization. Are there others?
No, there is. I can give one anecdotal evidence. So I was on a investor meeting. I used to do a roadshow every quarter to go meet with investors in the fund. And one of those times, the investor asked a question. Yesterday, X fund, which is a competitor, came to us, and they said this investment that they're looking at is one of the best in India. I was at an India fund at the time. Since I was doing both investor relations and I was doing research at the same time, and I knew the portfolio pretty well, I could immediately give them an answer as to why we didn't think that investment was right for the fund and the strategy that we were pursuing.
Right.
What that did is build an amount of confidence in the quality of people that my firm had.
Yeah.
That was one of the long-standing relationships we had.
Yeah.
So there is definitely an advantage to that. But also, when the organization becomes larger, clients also understand that roles are much more functional than cross-functional.
Mm-hmm.
One of the things that the book emphasizes multiple times is that there is no one-size-fits-all, especially in alternatives. And you need to understand where your strengths are, what your needs are, and play to those needs and strengths, rather than trying to force-fit yourself into whatever everybody else is doing.
But the best fundraisers are the most technical, and many of them I've seen have CFA charter holders.
Yes.
Yes, CFA.
Yeah.
Right. Yeah. Get your CFA.
Yeah, get your CFA. That's for sure.
So that is exceptionally helpful to understand the structures of the large firms. Now, agreeing that there's no one size fits all here, is there a particular difference for smaller firms that are earlier on in their stead?
I think smaller firms, you do have to think creatively about how you are going to leverage your resources and who you're going to partner with. So on the fundraising IR side, the teams will be the same, of course. And then these individuals or marketers may have other roles and responsibilities. So in one organization, I was their head of investor relations, as well as their chief compliance officer. So that was a very unique structure. I would not necessarily advise it, but there are some people that take that approach where they wear multiple hats in an organization. You can also leverage your placement agent and have them do a lot of the project management and creation of fund documents, that can really help a first-time fund as well.
That actually is very critical. As a first-time fund, you don't know what you don't know. This probably is your first rodeo. You may have done it somewhere else, but not to the same degree that you find when you're actually starting and running a fund. And the competing demands are just enormous to be able to handle by one person. Everyone feels, I can do it all. But you need to be realistic about what you can do. And that is where getting the outsourced placement, it might be a placement agent, leveraging your service providers for things that are essential, those become critical. The other thing that is also important is, in a larger fund, it's probably led by a team which is well known in the industry.
Right.
So the demand for somebody to meet with the portfolio manager to have the conversation from the investor is relatively lower than from a first-time fund. They want to meet everybody in the team. They want to really build that relationship with the portfolio manager as well, and then make the decision as to whether they want to continue or not. So to that degree, the entire firm becomes a marketing arm.
Okay, so when you spoke with funds to do this work, or even in your work with this book, or even your work before that, is there something do you think is typical that new fund managers underestimate? Is the operations or compliance, or what is it that people often underestimate will be difficult when they start their fund?
There are so many twists and turns and surprises that come through fundraising. I mean, if you estimate you're going to spend $1 million, you're probably going to spend $3 million. If you think you're going to spend 70 hours a week, it might be 140. And be prepared for the unexpected. I mean, that is the best advice that I can give you. It will also take twice as long at times, especially in this fundraising environment where a lot of emerging managers are having challenges in getting the attention of LPs and their first closes done.
Mm-hmm. Yeah, it's real tough now.
Yeah, the thing that I see some novice fund managers don't give enough credence or importance to is, for example, the documentation.
Mm-hmm.
They outsource stuff and think that it is all done.
Right.
It's never done without your involvement. You need to be engaged because you understand your product, your strategy, your philosophy far better than anybody else can represent it. So by not devoting enough time to that and underestimating those things, it becomes an issue later on. Be very cognizant about what terms you're putting in. Leverage relationships, get inputs from everyone else and decide what will be the market acceptable terms. Similarly, you want to be in side letter negotiations. The amount of, even for a small fund like ours today, the demand for side letters from every investor is quite high and everybody wants their terms. And you don't really think about these things when you're starting the firm. You think that you can get to it when you get to it, but it's never really the case. You need to allocate and resource for those eventualities.
What many emerging managers underestimate is how important it is to build momentum in the fundraise through having a good deal pipeline. Every investor will want to see some sort of visibility into what potential deals you have on the horizon and what is imminent. And the more deals you have under your belt, the more momentum you're going to have in finishing the fundraise efficiently and quickly. And so it's important to build relationships to investors and fundraise and market, but it's really, really important to build that deal pipeline.
Yeah, in private equity, that's a great thing, right? Every time you make an investment, you also have the opportunity to interact with investors and potential investors at the time.
Right.
So there is some positive momentum that you can create because there is a deal. People can, it's a touch and feel. They know what you're doing,
right? How
you're approaching investments. It's also a testament to your process.
Mm-hmm.
That cannot be done in a vacuum.
Right.
Absolutely great to make sure that your deal flow is important.
You want to be that pregnant primary. I don't know if you've ever heard of that. You want to be that pregnant primary where you are during a fundraise approximately 25% invested, because a whole new pool of capital can open up for you.
Well, perhaps we could leave it there. I'd just like to remind everyone who's online while they're listening to this, the book is Marketing Alternative Investments, a comprehensive guide to fundraising and investor relations for private equity and hedge funds. So thank you both for being here. And thank you all for listening to this podcast. I'm Rob Rowan, and this has been Compound Insights.